Don, inflation seems to be down, but it's not out. Commodities are typically a hedge against inflation. Why is that? And are they doing a good job of it right now?
Yeah, commodities have always done a good job in hedging against inflation. The issue has been the decade post the global financial crisis, inflation didn't really exist. They still serve the role as a portfolio diversifier, but now is an important time because you actually need that diversification.
So we've seen gold really take off. A lot of worries about the dollar, especially with the deficits that are running down in Washington. So can you talk about how much more the dollar has in it? Can it get up to 5,000 an ounce? How high can it go?
Yeah, I mean, gold has the role of gold is basically the currency that's been in play for the longest. And when you're looking at a time where fiat currencies are debasing and there's concerns about deficits, you want to look at real assets, and gold is the most basic of those real assets. I think that's why you've seen money come in both from central banks and the retail channel. I think we're in the early innings of that, and that, given the finite supply, 5,000 certainly seems realistic.
Okay, but it doesn't always have to be gold. Silver's done awfully well this year. It's up over 20% year to date. So what other metals or ways can people play the commodity complex?
All real assets are going to benefit from what's going on with currencies around the world and where we are from a debt situation. Obviously, gold and silver would be the most simple way of playing them, but there's a bull story for basically every commodity. In fact, especially ones denominated in dollars to ride that tide.
And in your opinion, what's the best way to play the coming commodity boom? Is it to buy bullion and put it in the safety deposit box? Is it to buy ETFs? Is it to buy the miners? Is it to go get some agriculture stocks or maybe even buy a farm? What should people do?
I think a broad basket commodity index type product is the best way to play it. You get the most diversification from that. It's very capital efficient. In most implementations, you even get a total return product, which means you're still earning a risk-free rate on top of your investment with your actual dollars. I think it's the safest way to play it and the most diversified way to play it.
And what are you watching at Quantix? You're watching Washington with the debt discussions? Are you watching the tariff discussions? There's a lot going on, and a lot of it will impact commodities. So talk about Quantix and what you're doing to capture all this angst that's out there.
That's a great question, and I think a lot of commodity traders were trying to watch the Washington do closely and getting very frustrated with the policy ping pong. What we've decided to focus on in Quantix is what is the end game of all this policy ping pong? Wherever it ends up, what are the consequences of having this policy uncertainty? And we believe we're moving to a world that is going to be much more deglobalized than it has in the past. And that deglobalization has bullish implications for commodities because you're taking away the efficiencies that came in a harmonized global world.
And then finally, there's nothing more historical than hard assets like gold and silver. And on the other hand, you have things like AI and Bitcoin, which are modern technologies. So can you just comment on how modern technologies are impacting the classical commodity complex?
Yeah, AI is essentially a power story. So if you're looking at how to play commodities related to AI, you want to look at power and what are the implications there. There's possible investments on where that power supply is coming from, but that's not exactly as certain to me as what infrastructure needs to be in place to serve that power, which is metals, particularly copper. I feel in any scenario, increased use of power means increased use of copper.
All right, well, thanks a lot for coming on and talking about it.
Thank you.